Welcome back to Silver and Metal IQ, your go-to channel for the latest insights on gold, silver, and the precious metals market. I'm Peter, and today we're diving deep into some extremely unusual activity that's shaking the silver market. If you've been watching the charts lately, you know things have gotten a little wild. Prices are swinging hard, and some of these moves look frankly suspicious. Stick around because we're going to break it down, analyze the numbers, and explore what it means for stackers, traders, and anyone invested in precious metals. Let's start by taking a look at what happened today. Silver had one of its most volatile days in recent memory. It surged to 80 late last night, only to be slammed down to a low of 76.31 during daytime trading, a 6.49 drop in a single day. That's a massive swing for silver, and it immediately raised questions across the market. Gold, platinum, palladium, and rhodium also took hits. Gold dropped $41.20, platinum fell $141, and palladium and rhodium saw losses in the single to triple-digit range. This kind of widespread pullback might look alarming, but it's a reminder of just how volatile precious metals markets can be, especially when momentum builds and forces meet resistance. Now, many analysts are calling this profit-taking, and that explanation has some validity. Traders who rode recent gains may be locking in profits, creating temporary pressure on the market. But there's a deeper story here, one that's causing whispers about price suppression. Could some of the massive swings be artificially capped? Are certain institutions limiting upward momentum to manage their positions? We can't say for certain, but the pattern is unusual enough that it warrants attention. What's particularly interesting is how quickly the market moves in response to global events. China's central bank, for instance, has been aggressively buying gold for 14 consecutive months, adding roughly 1.35 million ounces, 42 tons, since November 2024. These purchases show sustained official demand, and they heavily influence gold's relative stability compared to silver. While gold has been relatively resilient during today's sell-off, silver remains the wild card, prone to sharper short-term swings. Meanwhile, geopolitical factors are at play. The U.S. announcement that Venezuela would relinquish 50 million barrels of high-quality oil to the United States is creating waves in global markets. This move, coupled with increased civil unrest in Iran and tensions in the Middle East, has investors watching precious metals as safe haven assets. The dollar has strengthened slightly as a result, which puts short-term downward pressure on metals like silver. But as history shows, these dips often present opportunities for buyers rather than long-term threats. Finally, let's highlight today's massive intraday movements in silver. After the overnight surge to $82.80, the price faced what many are calling a brick wall resistance and collapsed down to $76.31. This rapid swing is raising questions about market dynamics and the influence of large institutional players who may have massive short positions to manage. Today's silver market action has been nothing short of extraordinary. After surging to $82.80 late last night, silver was slammed down to a low of $76.31 during intraday trading, a nearly $6.50 swing. Understanding why this happened requires looking at both market structure and global factors simultaneously. While some analysts chalk it up to profit-taking, the speed and magnitude of these movements suggest something more complex might be at play. Let's start with the technical dynamics. Silver faced stiff resistance around the $82-83 level, where it hit what some traders are calling a brick wall. Prices repeatedly tested this zone but failed to break through, leading to a sharp retracement. This kind of behavior is often a hallmark of markets with high short-term speculative activity, where traders rapidly react to momentum, triggering stop losses and cascading sell-offs. On top of that, volume surged precisely at key resistance points, amplifying the downward movement. The combination of resistance and high-volume selling created one of the most intense intraday swings we've seen in recent weeks. But technicals aren't the only driver. Geopolitical and macroeconomic factors are significantly influencing today's moves. The U.S. announcement regarding Venezuelan oil has global implications. By taking control of up to 50 million barrels of Venezuelan oil, the U.S. is asserting its economic influence while indirectly challenging China and Russia's energy dominance. This shift adds uncertainty to global markets and drives short-term volatility in metals. Investors watching these developments often flock to safe haven assets like gold and silver. But in times of extreme uncertainty, short-term reactions can still push prices lower before they stabilize. China's central bank also plays a critical role. With 14 consecutive months of gold purchases, totaling over 42 tons since November 2024, China is reinforcing a structural bullishness for precious metals. Even if silver experiences a temporary pullback, the overarching demand from institutional buyers ensures that such dips are potential accumulation opportunities for stackers. Physical silver remains tight, with premiums staying high due to supply constraints, while paper markets react more dramatically to short-term trading flows. Another layer to consider is price manipulation or suppression theories. Some analysts argue that large banks, still holding massive short positions, may exert influence to cap silver prices, preventing runaway momentum. While proving suppression is challenging, the repeated pattern of sudden spikes followed by abrupt declines raises eyebrows. It's not uncommon for institutional players to manage risk this way, especially in markets as thin and volatile as silver. From a trader's perspective, these swings create both risk and opportunity. For stackers focused on physical metal, short-term paper market moves are less critical, though they can create attractive entry points. For speculative traders, understanding resistance levels, volume surges, and macroeconomic triggers is essential to navigate these choppy conditions. Today, we saw how silver can swing $6 to $7 in hours, underscoring the need for strategic positioning and awareness of broader forces impacting the market. Volatility was a perfect storm of technical resistance, high-volume trading, geopolitical maneuvers, and institutional market activity. While some of it may be dismissed as routine profit-taking, the intensity of these moves shows that silver remains one of the most dynamic and sensitive assets in the current market environment. The key takeaway for investors and stackers alike is that these fluctuations are part of the journey, creating both risks and potential opportunities for those prepared to act wisely. The silver market isn't just moving randomly. There are several powerful forces shaping its current volatility, and understanding them can give stackers and investors a significant edge. Today, we saw wild swings between 82.80 and 76.31, and while profit-taking explains part of this, other underlying factors reveal why silver is still extremely bullish in the long term. First, consider the role of central banks and institutional buyers. China's continued accumulation of gold and indirectly influencing silver sentiment is reinforcing structural demand. The People's Bank of China has now added over 1.35 million ounces of gold since the start of its buying cycle in November 2024. This kind of official buying creates a floor for precious metals prices because it signals sustained, long-term demand that is less sensitive to daily market noise. Silver, though smaller in volume, is often influenced by gold's performance, meaning its upward potential remains strong despite short-term pullbacks. Next, the geopolitical environment is adding layers of uncertainty that affect both sentiment and price action. The U.S. recently seized Venezuelan oil shipments, a move signaling heightened geopolitical influence and challenging previous oil trade flows dominated by China and Russia. This has ripple effects across global markets. When geopolitical risk rises, investors flock to safe haven assets like gold and silver, but in the short term, these fears can also trigger volatile price swings as traders react to breaking news. The recent protests in Iran add another layer, creating an atmosphere where metals are sought not just for investment, but for protection against instability. Another key driver is market mechanics and technical dynamics. Today, silver encountered heavy resistance around $82–$83, creating a brick wall that forced prices downward. Some traders suspect price suppression, a theory suggesting large institutions holding short positions may intentionally cap prices to offload riskier bets. While hard proof is elusive, repeated patterns of abrupt spikes followed by sharp declines fuel this speculation. These dynamics highlight the difference between physical silver and paper silver. While the former remains largely unaffected by such manipulations, the latter can see dramatic intraday swings. Volume trends also tell an important story. The large sell orders early in the U.S. session amplified the downward move, but as trading continued, buying pressure began absorbing these flows, stabilizing the price. This illustrates a core principle for stackers. Short-term dips often create strategic accumulation opportunities. Even if paper prices fluctuate wildly, the availability of physical silver may be constrained, keeping premiums relatively high and ensuring that long-term stackers aren't losing value. Finally, it's important to understand market psychology. Volatility breeds fear, and fear can lead to overreaction. While some traders may panic sell during a $6, $7 swing in a few hours, experienced stackers recognize these moments as windows to add to their positions at favorable prices. The broader trend for silver remains intact, supported by central bank demand, industrial use, geopolitical risk, and monetary policy. Market isn't about panic. It's about dynamic forces interacting in real time. Between geopolitical events, institutional positioning, and technical resistance levels, silver is experiencing natural turbulence that will ultimately create buying opportunities for disciplined investors. For anyone watching the market closely, the lesson is clear. Volatility is not a threat. It's a chance to strategically strengthen your position in a historically undervalued asset. As we move deeper into January, the silver market is entering a critical phase shaped by a combination of macroeconomic indicators, geopolitical events, and technical setups. Understanding these catalysts is crucial for anyone looking to stay ahead in this volatile environment. One of the most immediate drivers is U.S. economic data. Recent reports, including a slowdown in job openings and rising debt levels, are hinting at broader economic softness. The national debt now exceeds $38.5 trillion, signaling that the U.S. may need to continue monetary stimulus measures. Historically, weak economic indicators coupled with aggressive central bank action create an ideal environment for precious metals. Lower interest rates reduce opportunity costs for holding non-yielding assets like silver and gold, while increasing the supply of money puts upward pressure on commodity prices. Interest rate expectations are another key factor. Market participants currently anticipate 2 rate cuts by the Fed later this year, but there is growing speculation that actual cuts could be larger, especially if inflation remains under control and geopolitical tensions rise. When monetary policy is more dovish than expected, silver tends to outperform other commodities due to its dual role as a monetary hedge and industrial metal. Traders should watch Fed announcements and CME Fed watch probabilities closely, as surprises in these indicators often trigger sharp short-term moves in silver futures. On the geopolitical front, recent U.S. actions in Venezuela and ongoing tensions with Iran continue to impact market sentiment. The U.S. seizure of Venezuelan oil shipments and the planned redistribution of these assets highlight America's renewed influence in strategic markets. This, combined with protests in Iran and rising uncertainty in global supply chains, reinforces silver's safe haven appeal. Historically, heightened geopolitical risk correlates with short-term spikes in both gold and silver, providing opportunities for tactical accumulation during dips. From a technical perspective, silver remains in a consolidation phase following its recent parabolic rise. The market has established a support range around 76-77 dollars, with resistance near 82-83 dollars. These levels are critical. A breakout above $83 could trigger another leg up, potentially targeting triple-digit prices, while a breakdown below $76 may offer a rare entry point for physical silver accumulation at a temporary discount. Stackers should use this range to plan incremental purchases, ensuring they capitalize on market swings without chasing volatile spikes. Industrial demand adds another layer of support. Even in economic slowdowns, silver's role in solar panels, electronics, and medical applications keeps a significant portion of its demand relatively inelastic. This makes sharp, long-term price declines unlikely, even amid short-term volatility. Coupled with strong interest from central banks like China, silver maintains a structural floor that protects long-term stackers from excessive downside risk. Finally, it's worth noting market psychology and speculative positioning. Large short positions by institutions, combined with sudden spikes and drops, often lead to claims of price suppression. While definitive proof is elusive, these dynamics explain why prices sometimes react violently to seemingly minor news. For stackers, this reinforces a key principle. Volatile paper prices are opportunities to accumulate physical metal, not signals to panic. The next few weeks will be pivotal. Keep a close eye on Fed policy, U.S. economic data, geopolitical developments, and technical support on resistance levels. Each of these catalysts can influence short-term price swings, but the broader trend for silver remains bullish. For stackers focused on long-term wealth preservation, these moments of volatility are precisely when strategic accumulation can create significant upside over the coming months. As we've seen in the previous segments, silver's recent swings, from highs above $82 down to $76, highlight the extreme volatility of the market. For stackers, these movements aren't a warning to exit. They're an opportunity to accumulate strategically. Understanding how to interpret these swings is key to building a strong long-term position. First, let's address timing and entry points. The market often reacts violently to macroeconomic and geopolitical events, creating sharp, short-term dips. These are the moments where stackers can take advantage. A fundamental rule is to buy on weakness, sell on strength, but only in the paper market. Physical silver should rarely be sold. It's a store of wealth, not a trading instrument. For example, during the recent dip to 76.31, stackers could consider initiating or increasing positions in 100 Oz bars, 1 kilo silver rounds, or high-quality coins. Premiums may be slightly higher than spot, but these are minor compared to the long-term potential. Next, consider allocation and diversification. While silver remains highly attractive, spreading holdings between gold, silver, and even platinum can mitigate risk. Gold acts as a stabilizer when silver experiences parabolic swings, while silver provides the upside leverage in the portfolio. Stackers should also monitor junk silver, 90% coins, as an affordable way to accumulate ounces during volatile periods. These coins often trade at or near spot prices and are difficult for banks or ETFs to manipulate, providing true ownership of physical metal. Technical analysis continues to play a pivotal role. Silver has formed a consolidation range between $76 and $83, creating a clear structure for tactical decisions. Breakouts above $83 could signal the next leg of a bull run, while temporary dips towards $76 offer entry opportunities. Stackers can use these ranges for incremental purchases, buying smaller quantities at different points to average cost effectively. This method ensures exposure without risking a full position at a single price. A key point often overlooked is the correlation between paper silver and physical silver. While futures and ETFs react quickly to market swings, physical silver supply is constrained. Dealers like SD Bullion or APMEX report sold-out bars and delayed shipping, indicating strong real-world demand. Even if the paper price falls, physical ounces remain scarce, which protects stackers from significant loss. Understanding this distinction allows for calmer decision-making during sharp corrections. Another strategic factor is monitoring institutional moves. Large players, including central banks and major ETFs, influence price action through rebalancing and derivative trading. The recent forced selling in silver from the Bloomberg Commodity Index is a perfect example. While the market may experience temporary downward pressure, these events often create buying opportunities for the informed stacker, rather than threats to long-term value. Finally, keep a long-term perspective. Even with short-term volatility, silver's fundamentals, industrial demand, monetary hedging, and geopolitical risk remain strong. Historical patterns show that temporary pullbacks do not alter the upward trajectory. Stackers who remain disciplined, accumulate on dips, and diversify wisely are positioned to benefit as silver moves toward triple-digit levels over the next cycle. Silver and gold have shown just how unpredictable and dynamic the metals market can be. From sudden surges to sharp pullbacks, we've explored the factors driving these moves, from central bank buying, ETF rebalancing, and geopolitical tensions, to industrial demand and macroeconomic policies. For stackers, the message is clear. Volatility is an opportunity, not a threat. Let's start with the key takeaways. First, silver remains in a strong bull market, supported by global monetary policies, rising industrial demand, and constrained physical supply. While short-term swings, like the dip from $82 to $76, might seem dramatic, history shows that these are temporary corrections within a longer upward trend. Second, gold acts as a stabilizer in your portfolio. While silver offers leverage, gold mitigates extreme swings and ensures long-term value preservation. Next, consider stacking strategies. Accumulate on dips using incremental purchases to average costs. Focus on physical silver, bars, coins, and rounds, because while paper derivatives can fluctuate wildly, physical ownership remains secure. Include diversification between metals, silver, gold, and even platinum, to protect against unexpected shocks. And don't overlook junk silver for cost-effective accumulation during market volatility. Understanding market manipulation and institutional moves is also crucial. Rebalancing by large funds or sudden derivative selling can create temporary downward pressure on prices. In these moments, stackers can strategically increase holdings. However, always remember that these are short-term fluctuations, and that your physical holdings are insulated from paper market volatility. Geopolitical events like U.S. interventions, shifts in oil markets, and rising tensions in key regions also influence silver and gold. These events drive safe haven demand, creating opportunities for long-term accumulation. By staying informed and monitoring these trends, you can make smarter, more timely decisions for your portfolio. Finally, a financial disclaimer is essential. The content provided on Silver&Metal IQ is for educational and informational purposes only. Nothing in this video constitutes financial advice, investment recommendations, or a solicitation to buy or sell any asset. All trading, investing, and stacking decisions carry risk, and viewers should conduct their own research or consult with a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. To summarize, silver and gold are at the center of a complex, fast-moving market. Volatility creates opportunities for disciplined stackers who understand the fundamentals, track market trends, and remain patient. The key is strategic accumulation, diversification, and long-term perspective. Thank you for joining us throughout this series on Silver&Metal IQ. If you found this content valuable, make sure to like, share, comment, and subscribe, and follow for ongoing updates on precious metals markets. Stay informed, stack wisely, and protect your wealth.